This morning we saw the release of Switzerland's inflation rate both year on year and month on month. I'm on the line with Grech of Exante to discuss his forecast for the outcomes of these releases. George, welcome. Firstly, over the course of 2014 so far, we've seen Switzerland's inflation rate fluctuate, peaking at 0.4% in March and dropping to minus 0.1% in June. How did the outcome of today's data release reflect your forecast for the Swiss inflation rate over the month of July?
Although the year-over-year change in the market expectations wasn't different, it was a little disconcerting to see the month-over-month inflation come in at minus 4.4% versus consensus expectations of minus 0.2%. Now, Switzerland, like many other developed countries, are continuing to battle against deflationary forces, and today's data will bolster the view of many participants that the S&B will retain their franc cap into 2016 in their continued attempt to fuel inflation. At present, it's fair to say that there's a total lack of inflationary pressure in Switzerland.
Last week, the Swiss National Bank suggested that house prices in Switzerland continue to rise. The boom comes from Swiss citizens and residents moving their investments back to Switzerland's relatively stable domestic housing market after the collapse of house prices in other countries. How do you foresee this influx of investment having an effect on Switzerland's interest rate?
The Swiss National Bank's expensive monetary policy has kept down the cost of taking out a mortgage. This has led to very strong gains in property prices. Indeed, we're seeing this dynamic in many countries around the world, so Switzerland here is no exception. In Switzerland, the mortgage lenders, the government, and the central bank have come up with a variety of measures to combat rising property prices, which has been fueled not just by ultra-low interest rates, but also immigration and Switzerland's appeal as a safe haven for financial investors. So as you can see, Charlie, this is not just about repatriation of Swiss citizens' money. These measures have included some of these measures included demanding lenders to retain more capital against their mortgage lending, disallowing the use of pension funds for down payments on property, and also stiffer standards in general for mortgage lending. The S&B still can't use interest rates as a policy tool just yet, so the risk to the Swiss franc breaching its cap is all too real, so interest rates is off the table for the S&B. Incidentally, many of the world's central banks are watching to see if this experiment works. It hasn't been done before. So what they're trying to find out is, can you manage real estate prices with non-monetary tools? I suppose we're going to find out in short order, although initial indications are that it's working as intended for now.
And finally, what do you foresee as the outcome of Thursday's ECB interest rate decision data release? And how do you see this as affecting the value of the Swiss franc?
Well, it's reasonable to say that the ECB is still monitoring the impact of the June rate cut. Now, although inflation in many EU countries have recently ticked down, which in itself is very disconcerting, there is some risk that Mario Draghi may sound somewhat more optimistic, as recent economic data have shown a slight improvement, and this includes the German retail sales numbers and French consumption, in addition to other various credit reports and bank surveys. One thing for certain, I'm sure there are some members of the ECB that are happy to see the recent decline in the euro.
Well, that's all we've time for today. Thank you, George, for all your insights. Remember to continue to click back on the Dukascopy site for more insights into your trading week. But for now, goodbye.